The dollar is dying. This is what happens next. If the dollar collapsed tomorrow, your savings account would be worthless by lunch. Gas stations would close. Grocery stores would be empty. Your paycheck wouldn't clear. Within 48 hours, the entire economy would grind to a halt. Not because America ran out of resources, but because the world stopped accepting the currency we've relied on for 80 years. That sounds extreme, but in 2022, it actually happened to a country holding $600 billion in reserves. Russia got kicked off SWIFT. Their dollar reserves froze overnight. Suddenly, all that money became worthless numbers on a screen they couldn't touch. It sent a message to every country holding US dollars. Your money is only yours until Washington decides it isn't. India watched. Brazil watched. And they all started asking the same question. What if we're next? A dollar isn't just losing value against other currencies. It's losing something far more dangerous: trust. When countries stop believing the dollar is a safe place to park their wealth, the entire system that's held since World War II starts to crack. For 80 years, the US dollar operated on an unspoken contract. You hold dollars, we don't mess with them. Countries kept their reserves in dollars because they believed those dollars would always be there, always be accessible, always hold value. That contract just broke. The dollar became the world's reserve currency after the Bretton Woods Agreement in 1944. Europe was destroyed. The US had the gold, the economy, and the stability everyone else needed. Countries agreed to peg their currencies to the dollar, which itself was backed by gold at $35 per ounce. Even after Nixon ended gold convertibility in 1971, the dollar stayed dominant because nothing else came close. It had the deepest financial markets, the most liquid assets, and the backing of the world's largest economy. But being the reserve currency gave the US a weapon most people never thought about. Control the dollar, control global trade. Almost every international transaction flows through the SWIFT network, a messaging. The US doesn't technically own SWIFT, but because most transactions settle in dollars, the US can effectively cut anyone off from the global financial system. Here's what that looks like in practice. In 2023, the U.S. froze $7 billion of Afghanistan's central bank reserves with a single executive order. The Afghan government couldn't access their own money. Imagine waking up to find your country's entire savings account locked by a foreign power. And in 2022, they used that weapon. When Russia invaded Ukraine, Western countries froze roughly $300 billion of Russia's foreign exchange reserves held in dollars and euros. Overnight, Russia couldn't access a huge chunk of its national savings. Overnight, Russia couldn't access a huge chunk of its national savings. The sanctions were designed to cripple Russia's ability to fund its military, and they worked to some extent. But they also did something else. They showed every other country that holding dollars means accepting a political risk. China holds over $3 trillion in foreign reserves, much of it in U.S. Treasury bonds. India holds substantial dollar reserves. Brazil, Saudi Arabia, the entire developing world, they all keep dollars as a safety net. But Russia's experience made them realize those reserves aren't actually safe if they ever find themselves on the wrong side of U.S. foreign policy. The dollars in their central banks could vanish with a signature in Washington. This isn't a theoretical concern. The U.S. has steadily expanded its use of sanctions over the past 2 decades. According to recent data, the U.S. has imposed over 6,400 sanctions on Russia alone since the invasion.
That's nearly 1/3 of all global sanctions against any country.
The trend extends beyond Russia. Iran, Venezuela, North Korea, and dozens of other countries have faced similar restrictions. Each sanction reinforces the same lesson: the dollar is a political tool, not just an economic one. This matters because it sets a precedent. If the U.S. can freeze $600 billion of Russia's reserves, they can freeze anyone's. Not your personal bank account, but if you're a country holding dollars, you're now asking, what if we're next? That question is driving the biggest shift in global finance since World War II. The problem for the U.S. is that weaponizing the dollar only works if everyone still needs dollars. And increasingly, they're finding alternatives.
BRICS nations, Brazil, Russia, India, China, and South Africa, have been buying gold like they're preparing for the end of the dollar era.
Because they are. In September 2025 alone, These countries purchased nearly 20 metric tons of gold, a $2.54 billion investment in a single month. Brazil added 15 tons, its first major purchase since 2021. Russia now holds 2,336 tons. China holds 2,298 tons. Together, BRICS nations control over 6,000 tons of gold, roughly 20% of all central bank gold reserves worldwide. This isn't random accumulation. It's a coordinated strategy. Gold doesn't freeze. Gold doesn't require SWIFT. Gold can't be sanctioned by a signature in Washington. When you hold physical gold, you hold an asset that exists outside the dollar system entirely. The World Gold Council reports that 73% of central banks now view gold as strategically important. That shift reflects a broader loss of confidence in dollar-denominated assets as a reliable store of value. To put this in perspective, if you stacked all the gold BRICS nations bought in 2025, it would fill a shipping container every single month. That's not accidental. That's a deliberate strategy to de-dollarize. But gold alone doesn't solve the problem of conducting trade. You can't pay for oil shipments or manufacturing components with gold bars. That's where the shadow economy comes in. Countries aren't just buying gold and hoping for the best. They're building the infrastructure to trade without dollars entirely. Because they've learned that relying on the US dollar is like keeping your money in a bank that can lock you out whenever it wants. Russia and China have been building alternative payment systems that bypass SWIFT entirely. Russia created SPFS, its own financial messaging system. China has CIPS, the cross-border interbank payment system. These aren't as sophisticated or widely used as SWIFT yet, but they're functional, and they're growing. More importantly, countries are increasingly trading in their own currencies instead of dollars. When India buys Russian oil now, they're not using dollars. They're using rupees and rubles, or sometimes settling through third-party currencies. China and Brazil signed an agreement to trade directly in yuan and reals. Saudi Arabia has started accepting yuan for Chinese oil purchases. These bilateral agreements chip away at the dollar's role as the universal middleman in global trade. The scale of this shift is significant. US-Russia trade collapsed from $36 billion in 2021 to $2.48 billion in 2024, a 15-fold drop. But Russia's overall trade didn't collapse, it redirected. Trade between Russia and India more than doubled after 2022. Trade with Turkey and China surged. Research shows that Russia liberalized trade with non-sanctioning countries beyond what normal economic factors would predict. Here's what that means for the dollar. Russia proved that countries can survive without it. That's the real threat. Not that Russia's economy thrived. It didn't. But it survived without dollar access. And if Russia can do it with the entire Western world against them, so can anyone else. This creates a two-tier global economy. One tier operates in dollars, uses SWIFT, and plays by Western rules. The other tier operates in local currencies, uses alternative payment systems, and avoids dollar dependence. The second tier is smaller and less efficient right now. Every country that joins it represents one less participant in the dollar system. The infrastructure supporting this alternative system is actively under development. BRICS nations are planning to create their own currency, backed by gold, and build their own payment systems, like BRICS Pay. The goal is simple: create ways to trade money without needing the US or Western countries. The gold accumulation isn't just about holding reserves. It's about backing these future currency mechanisms and demonstrating economic credibility in international negotiations. Despite everything working against it, the dollar isn't going anywhere quickly. And there's a simple reason why. There's no viable alternative. The euro is the closest competitor, but it has its own problems. The Eurozone is a collection of countries with different economies and different fiscal policies, and a history of crisis management that doesn't inspire confidence. The Chinese yuan could theoretically challenge the dollar, but China maintains strict capital controls. You can't be a global reserve currency if people can't freely buy, sell, and move your currency around the world. The dollar's dominance isn't just about economic size. It's about financial market depth. The US has the deepest, most liquid financial markets on the planet. When you hold dollars, you can instantly convert them into treasury bonds, corporate debt, equities, anything. That liquidity matters enormously to central banks and institutional investors. No other currency offers that combination of safety, liquidity, and market depth. Here's the paradox. The dollar is both the most powerful and most vulnerable currency in the world. Powerful because nothing can replace it yet. Vulnerable because everyone knows it eventually will be. That uncertainty is what's driving the shift we're seeing right now. History shows that reserve currency transitions take decades, not years. The dollar didn't actually overtake the British pound until the mid-1920s. Even then, the pound remained significant until after World War II. The transition from sterling to dollar took roughly 50 years. The whole world is built around dollars. Every bank, every trade deal, every investment uses dollars. Changing that takes forever because everyone's connected to the dollar system. You can't just flip a switch. So yes, transitions take decades. But here's the catch. We're not in a normal transition. BRICS is accelerating the timeline by building alternative systems right now. That's why this shift is happening faster than historical precedent would suggest. Recent data confirms the dollar's resilience. As of 2025, the dollar still accounts for roughly 58% of global foreign exchange reserves. That's down from peaks above 70% in the early 2000s, but still dominant. The euro sits around 20%. Tiny pie slice labeled 3% with yuan symbol. Accent, yellow highlight on tiny slice. When global crises hit, investors still flee to dollars and U.S. Treasury bonds. That flight to safety reflects deep-seated trust in U.S. institutions and markets. The U.S. gets a huge advantage from printing the world's reserve currency. The U.S. gets a huge advantage from printing the world's reserve currency. The U.S. can borrow money cheaply and run bigger debts because everyone still wants dollars. This creates a loop. As long as the world needs dollars, America stays powerful, which keeps the dollar strong. But that loop only works if people keep trusting the dollar. The dollar isn't dying overnight, but it is dying slowly. Every country that diversifies away from dollars is another crack in the foundation. Every bilateral trade agreement in local currencies adds another. Every ton of gold purchased by a central bank widens that crack. The dollar's dominance rests on trust, and that trust is eroding. For Americans, this matters now. A weaker dollar means higher prices on imported goods, from electronics to pharmaceuticals. It means higher interest rates on mortgages and credit cards as the U.S. borrows more expensively. It means your purchasing power abroad shrinks. And it all accelerates the moment the world decides the dollar isn't worth holding anymore. That moment might be 5 years away. It might be 10. But the countdown has started.